Gold shatters $5,000, silver $78. Thursday, crash pattern. Broken. What's coming Friday? For 3 consecutive weeks, something was happening in the gold and silver markets that most analysts refused to name out loud. Every Thursday, without exception, prices fell. Not randomly, not chaotically, but with a precision that felt almost mechanical. Week 1, Thursday. Gold dropped, silver followed. Week 2, Thursday. Same story, different day, same result. Week 3, Thursday, again. And each time the financial media had a ready-made explanation. Profit-taking, geopolitical cooling, routine correction. The language changed slightly every week, but the conclusion was always identical. Nothing to see here. But here's what the data actually showed. In any functioning market, price movements of this consistency do not happen by accident. Markets are not casinos where the ball randomly lands on red 3 weeks in a row. Markets are ecosystems, and ecosystems respond to incentives. To understand what was happening every Thursday, one must understand a concept that Wall Street prefers to keep in the fine print: options expiration cycles. Every month, institutional traders, the largest banks, hedge funds, and market makers on the planet, hold enormous options. Positions in gold and silver. These are contracts that pay out based on where the price of gold and silver lands at expiration. The critical detail? Many of these contracts are structured to profit when prices stay below a certain level, and the closer the market gets to expiration day, the stronger the financial incentive becomes to push prices downward. This is not a conspiracy theory. This is market structure. This is documented. This is the architecture that serious analysts study while retail investors watch price charts and wonder why their logic keeps failing them. Every Thursday for 3 consecutive weeks, the data showed the same institutional fingerprint. Selling pressure appeared not organically, not from genuine fear or macroeconomic deterioration, but in coordinated windows. Brief, targeted, effective. Gold would slip, silver would follow, headlines would explain it away. And by Friday close, the damage was done. Options positioning was protected, profits were secured, and the retail investor was left holding a loss they couldn't explain. This is perhaps the most important question, and the most uncomfortable to answer. Human beings are pattern-seeking by nature. When something happens once, it is an event. When it happens twice, it is a coincidence. When it happens 3 times in a row, the mind begins to normalize it. By the 3rd Thursday, many traders had already built the crash into their strategy. They were selling ahead of Thursday, expecting the dip, planning to buy back in on Friday afternoon. The pattern had become so widely accepted that it was being traded around rather than questioned. And that is precisely when patterns become most dangerous. Because when the market collectively stops questioning a structure, the structure gains power. It becomes self-fulfilling. Traders exit early Thursday. Prices fall on reduced buying pressure. Institutional shorts collect. Everyone goes home. The cycle repeats until it doesn't. This Thursday was different. Gold did not fall. Silver held. For the first time in 3 weeks, the Thursday crash pattern was broken. Now, to the casual observer, this might look like good news. Prices held. Stability returned. Perhaps the selling pressure has exhausted itself. But to the analyst, who has been watching the structure beneath the surface, this is not a moment of relief. This is a signal. Because patterns this institutionally enforced do not simply fade away. They break for a reason. Either the selling side ran out of ammunition, or the buying side arrived with more firepower than anyone anticipated, or something changed in the information environment that made suppression no longer viable. Any one of these explanations carries significant consequences for what comes next. And what comes next is Friday. NYC monthly options expiration day, the single most consequential market event of this week. The pattern is broken, the clock is running, and somewhere between tonight and tomorrow's closing bell, the market will reveal exactly what and who forced that break. Trump's Iran ultimatum, B-52 bombers, and the oil surge. Nobody is pricing correctly. There's a particular kind of silence that falls over financial markets, right before something enormous shifts. Not the silence of calm, not the silence of stability, but the silence of calculation, the silence of large, intelligent money quietly repositioning itself before the rest of the world reads the headline. That silence arrived this week, and it did not arrive alone. The ultimatum that changed the equation. On the surface, Trump's 10-day warning to Iran regarding its nuclear program read like familiar geopolitical theater. Strong language, firm deadlines, the kind of statement that news cycles consume and discard within 48 hours. But serious analysts do not read statements, they read timelines. And this timeline carries a weight that most financial commentators have significantly underestimated. Consider the historical record. When the United States issues a formal public time-bound ultimatum to a nuclear-adjacent state, The probability of that deadline passing quietly is historically very low, not because war is inevitable, but because ultimatums of this nature are never issued in isolation. They are issued when diplomatic back channels have already failed, when the private conversations have already collapsed, when the decision has already been made at a level the public cannot see. The 10-day window is not a negotiation opener. It is a closing argument. And markets, the ones that move before headlines, already understand this. What oil is actually telling us. U.S. crude oil futures are up 12% over the past month. That number, presented alone, sounds significant but manageable. A 12% move in oil is not unusual in a volatile geopolitical environment. Financial media will frame it as a reaction, a temporary spike, something that normalizes once tensions cool. But here's what that framing deliberately ignores. Oil is not reacting to the Iran ultimatum. Oil began moving before the ultimatum became public. That 12% climb, reaching the highest level since August 2025, did not begin this week. It began weeks ago, quietly, steadily, without the dramatic catalyst that would typically explain a move of this magnitude, which means one of two things. Either the oil market has been responding to a deteriorating geopolitical reality that the public statements have not yet fully reflected, or sophisticated energy traders received signals through positioning data, satellite imagery, diplomatic intelligence, or supply chain disruption patterns that something significant was approaching. In either case, the conclusion is identical. The oil market knew before the announcement, and when oil knows before the announcement, precious metals are never far behind. The B-52. Detail that changes everything, buried beneath the headline of U.S. President warning, mentioned briefly, contextualized minimally, was a single military development that the business community cannot afford to misread. The United States has positioned nuclear-capable B-52 Stratofortress bombers at Al Udeid Air Base in Qatar, 720 miles from Iranian territory. This is not a defensive posture. B-52 deployments of this nature are not logistical. They are not routine. They are not the kind of military movement that happens as a precautionary measure while diplomacy remains viable. In the language of military signaling, a language far older and more precise than anything spoken in press conferences, this deployment communicates a single message with absolute clarity. The conversation is nearly over. For the business community watching this unfold, the critical question is not whether conflict occurs. The critical question is what the positioning of this asset class tells us about how power structures are reading the next 10 days. And the answer that positioning provides is not reassuring. What serious capital is doing quietly. While headlines debated the tone of Trump's language, while analysts argued about whether the Middle East was genuinely at peace, a different conversation was happening in the rooms where allocation decisions are made. Gold was already at $5,000, silver was holding at $78 in Western markets, while simultaneously trading at $86 in Shanghai. That $8 premium between East and West is not an arbitrage anomaly, it is a directional signal. Eastern institutional money, which operates with a different information architecture than its Western counterpart, was pricing gold and silver at levels that Western spot markets had not yet accepted. When East and West price the same asset differently, the West is always the one that eventually adjusts. And that adjustment, combined with a broken Thursday pattern, combined with a 10-day nuclear ultimatum, combined with B-52 bombers 720 miles from Tehran, creates a convergence that serious decision makers cannot responsibly ignore. Zero gold discoveries, silver backwardation, and the inventory math nobody wants to do. There is a number that the mining industry has never seen before. Not in modern history, not in the era of satellite geological surveys, not in the age of artificial intelligence, assisted mineral mapping. Not in a period when exploration budgets reached into the billions annually. That number is zero for 2 consecutive years. Not a single major gold discovery was made anywhere on this planet. Let that settle for a moment. Not one. In a world where technology can map ocean floors, sequence human genomes, and land rockets on moving platforms, the Earth yielded no new significant gold deposit. 2 years, 0 discoveries. And almost nobody in the mainstream financial press considered this worth a headline. The geology that Wall Street refuses to read. To understand why this matters, not symbolically but structurally, one must understand the relationship between discovery and production. Gold mining is not like manufacturing. A car factory can increase output by running a third shift. A semiconductor plant can accelerate production by adding capacity. These are industries where human decision-making can directly influence supply response. Gold does not work this way. From the moment a major deposit is discovered to the moment it produces its first commercial ounce of gold, the average timeline is between 10 and 20 years. Permitting, environmental assessment, infrastructure construction, extraction engineering, processing facility development. The gold that enters the market today was discovered decades ago, which means the gold that should enter the market a decade from now was supposed to be discovered today. And it wasn't, for 2 consecutive years. This is not a supply disruption. This is a supply ceiling, arriving quietly, without announcement, without drama, without a single emergency press conference from the institutions whose entire valuation models depend on gold remaining abundant. The math is not complicated. Demand is rising. Discovery is zero. Existing mines are depleting, and the pipeline that should be filling the gap behind them is empty. First Majestic and the silver production. Paradox. Against this backdrop of geological scarcity, First Majestic Silver reported something that initially appears contradictory. Revenue of 464 million silver production, up 77%. On the surface, this reads as abundance, as expansion, as evidence that the supply side of silver is healthy and growing. But serious analysts do not read production numbers in isolation. They read them against the market structure they exist within. First, Majestic's production increase is real. It is significant. It reflects genuine operational execution at the mine level. But here's the paradox that the headline obscures. A 77% increase in production from a single major producer, in a market where Shanghai spot prices are trading at an $8 premium over Western prices, does not indicate surplus. It indicates that even with aggressive production expansion, the market is still not satisfied. Supply is growing, and demand is still outpacing it. When a market absorbs a 77% production increase without price correction, that market is not oversupplied. That market is structurally starved. China's silver backwardation, the signal, hiding in plain sight of all the data points circulating in precious metals markets this week, the one that deserves the most serious attention from the business community is the one receiving the least. China's silver market has entered backwardation. For those outside the commodities trading world, this term requires precise definition because its implications are severe. In a normal, healthy futures market, prices for future delivery are higher than prices for immediate delivery. This is called contango. It reflects the cost of storage, insurance, and financing over time. It is the natural state of a market with adequate supply. Backwardation is the opposite. When a market enters backwardation, immediate delivery commands a higher price than future delivery. This happens for one reason and one reason only. The market does not trust that the supply will exist in the future. Buyers are paying a premium to take possession now because they are not confident the metal will be available later. The deferral fee, the detail that confirms everything. But China's silver backwardation this week carried a detail that elevated the signal from concerning to critical. Short sellers, institutions that had sold silver they did not physically possess, betting prices would fall before delivery was required, began paying deferral fees. These are fees paid to avoid taking or making physical delivery. Think about what this reveals. These institutions sold silver, they collected payment, they made a market bet, and when delivery day arrived, they could not source the physical metal at a price that made delivery economically viable. So instead of delivering, they paid a fee to delay. At record high levels, this is not a market functioning under normal stress. This is a market where the gap between paper promises and physical reality has grown so wide that the institutions who built their positions on that gap are now paying in real currency to avoid the moment of reckoning. The inventory math nobody wants to do. Pull all of these threads together and the arithmetic becomes unavoidable. Zero gold discoveries for 2 consecutive years. A silver market absorbing a 77% production increase without flinching. Chinese backwardation at record levels. Short sellers paying deferral fees to escape physical delivery. An $8 premium between Shanghai and Western spot prices, signaling Eastern institutional conviction that Western prices have not yet accepted reality. This is not a single data point suggesting market stress. This is a convergence of independent signals, geological, structural, institutional, and geographical, all pointing toward the same conclusion. The physical supply of precious metals is not keeping pace with the structural demand being created by the geopolitical environment described in Part 2. And markets eventually price reality, not narratives, not managed expectations, not coordinated suppression patterns. Reality. The Thursday crash pattern held for 3 weeks because institutional incentives made suppression viable. It broke this Thursday because something in the balance of power between paper and physical shifted. And tomorrow, Friday, NYC Options Expiration Day arrives into this environment. Not into a calm market, not into a balanced supply picture, but into a market where the geological clock is running out. The physical inventory is tighter than any mainstream report acknowledges, and the geopolitical match has already been struck. NYC monthly options. Expiration, market positioning, and what comes next. Every market has a moment where all the forces that have been building beneath the surface are finally forced into the open, where the positioning is revealed, where the bets are settled, where the institutions that spent weeks managing narratives must finally face the one thing they cannot manage. The close, that moment, is tomorrow. Friday, NYC monthly options, expiration day, and it is arriving into the most structurally complex precious metals environment in recent memory. What options expiration actually means for this market. For the business community watching this unfold, a precise understanding of options. Expiration mechanics is not optional. It is the difference between reading tomorrow's market movement correctly and being surprised by it. Every month, the New York market settles an enormous volume of options contracts on gold and silver. These are not small retail positions. These are institutional arrangements, built over weeks, sometimes months, representing billions of dollars in directional bets on where precious metals prices will land at the precise moment the market closes on Expiration Friday. The critical dynamic is this: institutions holding short options positions, contracts that profit when prices stay below a certain level, have spent the past 3 Thursdays reinforcing a suppression pattern designed to protect those positions through expiration. The logic was clean, the execution was consistent, the pattern worked, until yesterday. Because when the Thursday pattern broke, the calculus that every short option holder had built their expiration strategy around broke with it. And now those institutions face a Friday they did not prepare for, the conflict at the heart of tomorrow. Here is where the analysis becomes most consequential for serious decision makers. 2 opposing forces are now converging on the same Friday close. On one side, the institutional suppression incentive. Options expiration creates powerful financial motivation to push prices downward in the hours before close. This incentive did not disappear because Thursday's pattern broke. If anything, the failure of Thursday's suppression attempt may have intensified Friday's pressure as institutions scramble to recover the ground they failed to hold yesterday. On the other side, everything documented in parts 1, 2, and 3. A broken pattern, signaling a shift in the balance between paper and physical markets. A geopolitical environment generating genuine safe haven demand that institutional selling cannot indefinitely absorb. A supply picture so structurally compromised that even coordinated suppression is becoming increasingly expensive to maintain. And an Eastern market already pricing silver $8 above Western spot, effectively broadcasting, in the most precise financial language available, that the Western price is wrong. These 2 forces do not resolve quietly. They collide. And the collision happens tomorrow. 3 scenarios for Friday's close. Serious analysis does not predict. It prepares. And preparation requires understanding the full range of outcomes that Friday's structure makes possible. Scenario 1, controlled consolidation. Institutions partially recover their suppression capability. Prices hold relatively flat through the morning session, drift slightly lower into the afternoon as expiration pressure peaks, then recover modestly at close. The Thursday break is reframed by financial media as an anomaly. The pattern is declared restored. Short option holders settle their positions with manageable losses. The market exhales, briefly. But the underlying supply reality documented in Part 3 does not change. The geopolitical clock documented in Part 2 does not pause. And within days, possibly hours, the pressure reasserts itself at a higher baseline. Controlled consolidation is not resolution, it is delay. Scenario 2, decisive continuation. The buying pressure that broke Thursday's pattern does not retreat on Friday. Physical demand, driven by genuine institutional conviction, Eastern market arbitrage pressure, and geopolitical safe haven flows, overwhelms the expiration day suppression attempt. Gold holds above $5,000 through the morning session. Silver defends $78. As the afternoon progresses and short option holders realize suppression is failing, a cascade of short covering begins. Institutions that had sold silver they did not possess begin competing with each other to exit positions before close. The deferral fee dynamic documented in Part 3 accelerates. Physical premiums widen. The $8 gap between Shanghai and Western spot compresses, not because Shanghai falls, but because Western spot rises to meet Eastern reality. Friday, close prints above levels that make next week's options positioning fundamentally different from this week's. This scenario does not require dramatic price action to be consequential. It requires only that the suppression attempt fails. And this week, suppression already failed once. Scenario 3, controlled reversal with a trap. This is the scenario that the business community and serious capital allocators must approach with the greatest discipline. Institutions engineer a sharp, aggressive downward move in the early Friday session. Gold tests support below $5,000. Silver pulls back toward $75. Financial media immediately declares the Thursday break a false signal. Retail participants, who repositioned based on the pattern break, are stopped out. Sentiment shifts from cautious optimism to renewed uncertainty. And then, Quietly, in the final hour of trading, institutional buyers re-enter at the exact levels they engineered. The reversal was not a genuine change in market direction. It was a liquidity extraction event, a mechanism for large buyers to accumulate physical and paper positions at artificially suppressed prices before the weekend, before Trump's 10-day ultimatum advances by 2 more days, before the B-52 deployment in Qatar generates its next headline. In this scenario, the trap is not set for institutions. It is set for the retail participant who sold into the manufactured dip. What the business community must watch by market close. For decision makers operating at a serious level, tomorrow's close should be evaluated against 3 specific data points, not price alone. First, the spread between Shanghai and Western spot at Friday's New York close. If the $8 premium narrows, Western price discovery is beginning to accept Eastern reality. If it widens, suppression is still partially functional, but increasingly expensive. Second, open interest changes in silver futures following expiration settlement. A significant drop in open interest accompanied by price strength indicates genuine short covering, not manufactured stability. This is the fingerprint of a market where paper promises are being retired because physical delivery has become the less manageable alternative. Third, the language, not just the outcome of any development in the Iran situation over the next 24 hours. Trump's 10-day clock does not pause for options expiration. Every statement, every military movement, every diplomatic signal released between now and Friday close lands in a market that is already structurally fragile. One significant geopolitical development in that window does not merely move prices. It removes the institutional capacity to manage them. The larger question that Friday will begin to answer, beyond the technical mechanics of expiration day, beyond the 3 scenarios, beyond the spread data and open interest figures, Friday carries a question that serious observers of economic history will recognize immediately. Are we witnessing a temporary dislocation, a moment of unusual market stress that resolves back toward the patterns and structures that preceded it? Or are we witnessing the early, visible edges of a structural transition, a period where the architecture of precious metals pricing, built on the assumption that paper supply can perpetually substitute for physical scarcity, begins to visibly strain under the weight of geological reality, geopolitical disruption, and institutional overextension? 3 weeks of pattern suggested the former. 2 years of zero gold discovery argues powerfully for the latter. The Thursday break did not answer this question, but Friday's close will begin to.